in a different size, but each one has suffered a lot. So the question of economic revival is before us. The economy has suffered a lot on various points, and we have to cover this topic with two eminent speakers. Before that, our chairman on the Committee on Management Accounting of Institute of Chartered Accountants of India will brief you on the topic as well as on the working of the committee. I'll first introduce the chairman of our committee, C.A. Charanjot Singh Nanda. As you all know, he is a powerful personality. Up to the BCom level, which he did in 1987, he has been in the merit list of the college as well as school. He is a born leader. He has been on the student union in his college and in the debate competitions in his school level. He was a chartered accountant in 1991 and a position holder in CA Intermediate. He is in practice since 1991. He has been Central Council member of the Institute of Chartered Accountants of India for the year 2019-2022. Before that, he has been on the council from 2004 till 2016 for the 4 consecutive terms. Before that, he has been in NIRC from 1998 to 2004 for 2 terms of 3 years each. He has chaired the NIRC in the year 2002-2003. He is now chairman of Internal Audit Standard Board as well as Committee on Management Accounting. He is vice chairman of Continuing Professional Education Committee of the Institute of Chartered Accountants of India. He is member on board of 26 committees of Institute of Chartered Accountants of India. Friends, he chaired many committees during his tenure of almost 15 years at CCM. He has chaired many standing as well as non-standing committees of the Institute of Chartered Accountants. He was a member of SEBI, Security and Exchange Board of India Advisory Committee on Primary Market for the year 2007-2010. He has been a member of SEBI Advisory Committee on Mutual Funds for the year 2007-2010 as well. He represented Institute of Chartered Accountants of India on SEBI Committee on Disclosures and Accounting Standards. He has been convener of expert group constituted by the Ministry of Corporate Affairs, Government of India on investor protection. He has been member of Southern Asian Federation of Accountants Committee on Professional Accountants in Business. He has authored a book, Practical Guide on Audit Documentation of Statutory Bank Branch Audit. He has been a guest speaker, guest faculty, and program coordinator of various seminars, conferences. The number is, I think, not known to he himself as well. He has addressed many gatherings, seminars, conferences in India and abroad. Friends, here I put before you the one and only powerful personalities, C.A. Charanjot Singh Nanda. Over to Nanda sir.
Thank you, Rasa, for such a wonderful, exhaustive presentation. You have made me nostalgic. I'm now thinking of what I did in the past. Thank you so much. Sir, I would like to introduce the topic. We now intend to work on a series. The name of the series is Management Accounting Insights. And the topic is Cost Management Strategies for Economic Revival. Let me very candidly tell you one very important thing. When you speak about cost management strategies for economic revival, you undoubtedly go and think about the past, which has been darker. I'm reminded of a couplet which says, Kar leta hu bardash har dard isi aas ke saath. Kar leta hu bardash har dard isi aas ke saath. कि खुदा नूर भी बरसाता है आजमाइशों के बाद. After every distress, the God is kind to give so many opportunities for us to go back. And your profession, the Institute of Chartered Accountants of India, which was set up an Act of Parliament way back on 1st July 1949, when the most important document to the democracy, the Constitution, was not adopted, is there to ensure that we give our best. Cost management essentially is a form of management accounting that allows a business to predict impending expenditures which needs to be reducing because they go over budget. In other words, cost management is concerned with process of finding the right project and carrying out the project in right way at the most economical cost. It includes certain activities which encompasses the entire arena of management accounting, including planning, estimating, budgeting, financing, funding, managing, controlling and benchmarking costs so that the project can be completed within time and there can be no cost escalation and the approved budget and project performance could be improved. Cost management covers the full life cycle of a project when it applies to a project. Cost control can be undertaken in three big ways. Number one, get everyone involved. When you go for cost management strategies, you have to find that the employees, all stakeholders, all outside world that is attuned or that is concerned with the project come and help you by eliminating inefficiencies or activities with a poor return on investment. Suppliers and vendors might also be roped in to offer ideas on how the company can reduce expenses or how they may be able to work with the company at a lower cost by changing payment terms or ordering patterns, and successful strategies may be applied over the industry, benchmarked with several other successful co-industry owners. Second, a review of standard operating process and intensive resources. SOPs drive the way I have Mr. D.D. Goyal, and I know he and Mr. Jaju will largely speak about processes. Process weakness needs to be plugged, and standard operating procedures have to be in place so that everything is done in the rightest form. Cost management has to apply a cost accounting perspective to business problems and focus on how business processes and activities can influence costs. Another way to build this knowledge is to have accounting and finance staff work with different units for a period of time to expand operational knowledge and gain first-time insights into cost drivers. Cost cutting is an essential area for a chartered accountant. Let me tell you, management consulting services have opened floodgates for practicing chartered accountants to offer these services, wherein by understanding the entire process, you advise the management how the cost can be limited. And the third and final step is use of cost management strategies as an accounting tool. Yes, we are essentially accountants. Even in good economic times, cost control is important because it improves companies' ability to operate from a position of strength. By being proactive and continually focusing on cost control methods, economy will be less likely to need to react suddenly to changing circumstances. As professionals, the best thing we can do to bring this economy back to rail is to ensure that cost is in control and we are able to effectively service the industry where we are as auditors, as internal auditors, as management consultants, or as retainers. Not take that because we have the very rare speaker who speak here, Mr. D.D. Goyal and Mr. Jaju. So, ladies and gentlemen, I would like to end by simply saying that the committee is fully sensitized to serve you all, and the full involvement of committee is there. Whenever you want a topic to be spoken on, please feel free to call me. I'm always available. You have my number. You could always go to ICAI.org and take my number and give a call to me, write a mail to me, or WhatsApp to me. I'm always there. The entire committee and secretariat is there to serve this profession, this noble profession of accounting. Thank you. Thank you so much. I give the dais back to Mr. I.S. Arora for further proceedings. Over to Dr. Arora.
Thank you very much for the words of wisdom, starting from planning to getting each one involved and benchmarking and ultimately cutting the costs. Thanks a lot. We have with us our keynote address, C.A. D.D. Goyal. It's always wonderful to listen to the business from a business leader. Mr. D.D. Goel is certainly a business leader. He is a chartered accountant since 1984 and passed the chartered accountancy with 9th rank in India. He is presently Executive Director of Finance at Maruti Suzuki India Limited, Gurgaon, and directly reporting to CEO and MD of Maruti Suzuki. He joined Maruti in 1984, 37 years back, and worked in various capacities. He handled many projects like IPO of the Maruti in 2003, Oracle ERP implementation, then Suzuki Powertrain India Limited merger with Maruti Suzuki, the company which was a wholly owned subsidiary of the Suzuki Japan. Led team for smooth implementation of GST at Maruti, which involved extensive interaction with senior officers of Finance Ministry of Government of India as well as state finance ministers. He is a chartered accountant. He did his graduation and post-graduation in commerce from University of Jodhpur with ranks in merit list in both the qualifications. Friends, Mr. D.D. Goel is a professional achiever and he got the Professional Achievers Award by the Institute of Chartered Accountants of India in the year 2010. He is member of various organizations in the industry. He is chairman of Taxation Procedural Committee of Society of Indian Automobile Manufacturers for past many years. He is a member of ICAI's National Committee on Taxation. He is a member of Regional Advisory Committee of Excise Department. He is on the governing body of Gurgaon Chamber of Commerce and Industry and much more. Here, ladies and gentlemen, I present before you CA D.D. Goel for the keynote address of today's program.
Welcome, Goel Sahab.
D.D. Goel.
I would like to just add that we have close to 1,000 participants who are viewing this program online. By the time you start, there will be more than 1,500 participants. It would be one of the very successful programs of the committee.
That's wonderful.
Thank you, sir. Thank you.
CA Nanda Saab and all other fellow panelists, good evening, namaskar. Thanks Nanda Saab and the CA Institute for giving me an opportunity. Being an employee or a student of accountancy, lifelong student, I share you stand for a minute. Observed, learned, actually practiced at Maruti Suzuki. As during introduction, this was the job which I started. I would share 2-3 key learnings. Sorry, first let me check. My voice is audible?
Yes, sir.
Yes, sir. Very much audible.
Okay. So I would share with you maybe 2-3 learnings which I learned in Maruti Suzuki and actually practiced, and we have been practicing on that basis. The topic, cost management for economic revival. My earlier directors and the Japanese seniors, first thing which we learned, that for a business, for survival, for growth, what we can manage is only cost. Sale price is determined by the customer and by the market. Sale is not it. So if you want to be profitable, and without profit, survival is not there. So you have a sale price, from reduced you desired profit, normal profit, then you derive the cost. Then it is our target to produce or supply the goods to the customer at that cost. So first thing is, cost management is the only way to survive and grow. That's the first thing which we all must learn, and I would say take it by heart that this is the only way. The second important point is cost management. There is one very useful sentence called strategic mistake can never be rectified or compensated by operational efficiencies. do I mean by this? That is when you plan any activity, any project, any product, there are some decisions. Those decisions must be taken with a proper evaluation. Those mistakes or those good deeds can never be compensated by afterwards operational small improvement and kaizens. Let us say in Maruti, we took a decision that all component manufacturers which are bulky, they must be located within the plant or at the boundary of the plant so that transportation cost can be minimized. Let us say in a car, big part will be seat or bumper or instrument panel. If we do not locate them near and locate say 100 kilometers away, that afterwards you may reduce your transportation cost. You may become little more extra efficient, but that mistake of locating that plant outside can never be compensated by small improvements. The first thing is when we design a process, when we design any product, we must look at the overall implications and take a right decision at the planning stage. Second aspect, that when we say cost management, it should be by a win-win formula. In any business, there will be one dominating party, but that does not mean by pressurizing or by short-term gain, we can sustain for long. So how does cost get reduced? Cost can get reduced only and only by removing the wastage and redundancies. We have to look at what is the material which is redundant, what is the movement which is redundant, what is the storage, what is redundant. All three are critical. It's not only the material. If a worker, like we pay to the worker for doing the work and not for walking. So you would see in automobile conveyor lines, the component would be placed in a what we call a slating conveyor roller, so that material, because of gravitation force, will keep on coming down and worker can just lift it, put on the car. If you will keep 5 feet away, then that fellow will have to waste. That movement becomes a waste. So each and every place, like in the coil by which you make a component, you have to look at what would be the ideal size. If you try to buy a little extra, that would be the cost. Same way storage, like you would have all heard the Japanese concept called JIT, just in time inventory. Because if you carry extra inventory, you need extra space, you need extra inventory carrying cost. So actual cost management is possible only by identifying redundancies. Redundancy would mean each customer willing to pay for that activity or that material. Redundancy should not be seen from perspective of manufacturer or seller or operator's convenience. Operator would be very happy that, okay, please keep 3 days inventory margin. The worker or the other people will be very happy, okay, keep extra space, so it becomes more comfortable. But what we have to check, each and every aspect, the customer who is going to buy your product, is he willing to pay for those redundancies? If we are able to remove all those redundancies, we can keep on getting the cost reduction. The second point, something which is maybe relevant and useful today, also have to constantly keep a watch on that. It may not remain relevant or useful afterwards. Let me share with you one or two more examples. Like when the VAT came in 2003, I'm going little into micro details. The input credit is available under sales tax or VAT for the tax paid by the supplier, state tax paid by the supplier. Same way, under mod VAT, input credit of excise is available. A traditional way, or you can say mechanical way, could have been put two teams or two persons. One person would process the invoice for taking the input credit of local VAT. Another person would be there who would process the invoice for taking excise mod VAT. When we implemented, we gave, like what I was saying, strategic planning. That what do we need for taking credit? Out of 10 to 12 particulars what you have to capture in the system or get it checked, 9 parameters are common. Supplier name will be common, invoice number will be common, invoice date would be common, material prescription would be common, basic price would be common. What is the difference is excise amount versus VAT amount. So what we did, we merged both the processes, merged both the teams, and on the same format, just add one extra column in the computer system, and the same team, maybe with 10% extra efforts, could process all the input credit. And just for information of the audience, the volume, like in Maruti, we get every day 20,000 invoices. 20,000 invoices per day. So almost more than 50 lakh papers every day. So instead of, in a year, if I look at, we would have to process 1 crore. Instead of 1 crore with the 50 lakh with extra some efforts of one column, we could save the cost of all those processing. That's one example of how do you do the planning and save the cost. Another last sentence which I would say, you must also look at your process or the equipments or the tool. Like we say, the X kulhadi. If you sharpen the X on the time, you will be able to cut much more wood and you will need less efforts. But if you do not spend time to sharpen your X and only keep on wasting your energy, even if your X has become blunt, although physically you may be doing a lot of efforts, but result will not come. So all fellow professionals here, our X is our brain, our mind. So we must all keep enough attention, enough energy, and proper time to train our mind so that we are able to handle our professional work with much more accuracy and speed. With this, I will close my talk. Thank you very much.
Thanks a lot, CADD Goelji. You have certainly given wonderful tips in your keynote address. The wonderful thing which you have told that it's only the costing which is in our hand. It's not the selling price or the otherwise, which is determined by various factors beyond our control. Then costing is important for survival and growth. Then operational decisions are very much important, can't be revisited always. Then wastage and redundancies, removal of that is the key. Certainly words of wisdom which will go a long way in cost cutting of various industries and will help our professionals attending this webinar. Thanks a lot. Friends, now the speaker of the day, CA BR Jaju. Our speaker for today's topic is a Master of Masters and has a vast professional experience of 44 years on his back. Friends, he is having a long professional career spanning over 44 years and is presently Executive Director and CFO for DB Power Limited, a mega venture in power sector of Bhaskar Group, Paskar Group being the largest in print media in India. He has been Director and CFO of Wellspun Corporation. He has been Global CFO of Crompton Greaves. He has been VP Finance and Company Secretary of Reliance Petrochemicals. He has been Group CFO and Company Secretary of VIP Industries. He has been Global CFO and Executive President Z Network. He has been Corporate Head Accounts, Legal and Company Secretary at Wipro. Friends, among several accomplishments, most notably include having significantly contributed phenomenal financial and operational turnaround of Crompton Greaves, enhancing the enterprise value over 150 times in just 9 years. Certainly remarkable. Certainly remarkable. Besides, he has to his credit several global merger and acquisitions and strategic fundraising activities both in India and overseas. Friends, he has been conferred matchless 5 times most illustrious national awards as best performing CFO, that again judged by the nationally renowned juries. In 2003 by IMA for Business Transformation, in 2005 by IMA for Excellence in Finance in Large Corporates, in 2006 CNBC TV18 and Toyota Corolla at Dubai. In 2013 by our own Institute of Chartered Accountants of India in the segment of Engineering and Capital Goods. Then in 2019 Marconomy CFO of the Decade. Friends, he is recipient of Wealth Maximization Award from BSC while serving as Executive President and Global CFO with Z Network. He has been conferred with most coveted Maheshwari Ratna Award 2012 from Maharashtra State Government, recognizing outstanding performance in private sector. Friends, he has served lot many places in associations. He has been chairperson of Finance and Tax Panel CII Maharashtra. He has been member of Economic Affairs Panel CII Maharashtra and CFO Forum CII. He has been special invitee for CII Western India Regional Council. He has been member CII National Council on Corporate Governance 2008. He has been co-opted member of the Committee of Members in Industry in our Institute of Chartered Accountants of India. He has the honor of speaking more than 300 times as a speaker, as a guest speaker, as a faculty in India and abroad. Friends, he believes in service to humanity and has been in the field with the medical clinic since 1992. Friends, he has honor of being honored as among top 100 Marwadis of Mumbai in 2012 in recognition of his service to humanity. Friends, his hobby is magic as well, and he has presented before 6,000 plus audience of this excellence. Friends, he has done MBA qualification at the age of 65 from ICAI. He is BCom FCA, All India rank holder, FCS and law degree holder from University of Mumbai. Here I present before you the one and only CA B.R. Jaju. Welcome, sir. Welcome to the webinar. You are not audible, sir. Mr. Yayus, you are not audible.
My apologies, sir.
Yeah,
Yes, sir, you're audible now.
you are
Please
Is
audible,
that
sir.
okay now?
It's okay now. Please start again, sir.
Sorry, my apologies to you. I
No
forgot
issues,
to
sir. No issues.
unlock that. First of all, at the outset, thank you very much, Arunaji, for your kind and generous words. And I think that has really elated me to speak on this platform. But I think you have spoken more than my personality. Respected Nandaji, Aroraji, Sri Goyalji, Palji, Gyanji, and ladies and gentlemen across the world, I propose to do in given time today to share with you some of my core learnings. As Goyalji has rightly brought the topic and context, I also follow the same path, and whatever best learnings which have contributed to respective organization I worked for in terms of creating a tremendous business value and enterprise value, of course with focus on cost management, because I still repeat the same thing, that it is cost management which is within control domain of company management. So friends, I have customized is a capsule of a small presentation. Of course, it's not that way small, but it is a relevant presentation, which brings a structural focus on my cost presentation. With your permission, I'll be taking that presentation on the screen. So is that can be seen now?
Yes, audible, sir, visible.
Visible. So what I'll do, I will make this little bigger size. F5. Is that readable now or? No. How come I'm is that I'm audible, sir? Audible, no? All right. So today the coverage I plan to take is what are the business dynamics changing and which have created some kind of anxieties and inquisitiveness among all of us, which are cost management drivers which will enhance business values. What are the financial tools, diagnostic tools basically, to measure the impact of CMS stand for cost management strategies and best CMS practices. Now from here, how do we ourselves now make our landing in next orbits I call as a emerging CMS orbits with respect to emerging opportunities. And I have just detailed out one corporate case study which I have been extensively part of that transformation cost management strategies. So I thought I will love to share that with you all. Traditional way of managing cost, and if no right practices and measurement tools, that is like dying companies on steroids. Before that, let me just deal quickly with the new age chartered or management accountant. Is that basic role? We have been talking role on various dimensions. As a Marwadi or as a prudent businessman, I consider three broad roles of any management accountant. One is that he or she must understand how the value or money is made or where the money is made, and vice versa, where the money is lost in the business. So I call that as a competency called value chain competency. Number two is appreciation the concept of risk. Today, with the kind of situation business is going global and subject to so many vagaries of risk elements. So he has to have risk competency. And besides that, business is now overseen by lots of stakeholders, which may be lenders, it can be governmental agencies, tax authorities, shareholders, many stakeholders. So you must have a expectation competency. So I repeat, these are the three important competencies. One is value chain competency, other is risk competency, and third is stakeholders expectation competency. And that's why I call a chartered accountant or management accountant in that role is nothing but as a strategic guardian of the economic value, because he's the one who wears that multiple hats, which can be like how in the areas of value creation, performance measurement, protection of stakeholders' interest, regulatory compliances, and people development. If I take you the three era in context of our Indian businesses, if I see that, and vis-a-vis I want to connect the role of management accountants and chartered accountants more. Prior to 1990s, I have been there in this era over last 45 years of his 37 years I am talking as a CFO. That time prior to 90, it is like we could sell whatever you produce at whatever cost, which means even cost inefficiency would not have mattered because of excessive protectional policies of the government, and manufacturer could sell because of governance practices and cost efficiencies. In era of 90 to 20, then we got exposed to international markets, both with regard to products and capital. So one has to achieve the viability of the operation. Here the role of now cost management strategies, all that have come into play. And when I talk of cost, it is not only cost of the product, I mean also cost of finance, also equally important. So that overall cost structure, the focus was coming within this era. Post 2020, or I would call COVID-19 phase, now it is a digital connectivity-led growth. In that context, we have to talk. We have to also see the change in mindset to become now global, local, and local company with changing trade equations, impact of COVID. So now this will bring some different dimension of the business dynamics, which we have to be mindful. Now there are various dynamics I have shown over here, and these impact overall business performance, profitability, sustainability, viability, and the very existence of the business. IT-enabled processes, mergers and acquisitions, business running according to the customer expectations, which are changing now fast, no more concept of like customer loyalty, governance best practices, business risk and unforeseen calamities like COVID has been one of the unprecedented and unforeseen kind of things, global competition and Atmanirbhar Bharat related things which have come in, regulatory compliances, changing business models, consolidation, outsourcing. I don't want to deal in detail because I would like to give my lot focus on basic cost management strategies. So we all are worried. I'm sure each of you would be really concerned with and inquisitive with your cost management, with shifting business gears and disruptive COVID-19. So what are the anxieties? If I can pick up from every one of your mind and want to put top 5 concerns and anxieties, in my assessment, the first anxiety is how do I protect my liquidity and its associated cost? Because I can still accumulate liquidity, but question is at what cost? So that is one, my inquisitiveness and anxiety. Second is my business continuity and insulating from leadership virus. You park this point in your mind because I will deal with this leadership virus through a separate slide. I can tell you based on a study of 200 Fortune 500 companies in a structured way, how leadership virus have killed the organization which are more severe than coronavirus. How to control infected components of working capital and associated cost. These components of working capital, I mean nothing but inventory, receivables and payables. So that is my third anxiety. Fourth is retention and safety of critical human resource to safeguard from cost disruption. And last anxiety is compliance to regulatory framework to save penalty met cost. So this is also a surging if compliance is not properly done. If you agree with me, then I have mentioned about something called leadership virus, something very new, but trust me that these viruses post, even you take a picture of 2008 onward, that's a study which has been done. These are the 4 viruses which have killed or destroyed the very business value or economic value of the nation or corporate anywhere. And these viruses are sitting in the minds of leaders. And we all are leaders working at in some position. So friends, what are these 4 viruses? One is when you come in denial mode. Now denial mode means what? There are conflicting interests. Business owner is running a parallel shows and there are conflicting interests with his running private shows and the company which is working for, or vendors arrangements and collaborations, questionable associations. I mean that kind of conflicting interest. So, and still you deny everything is arm length, which is not so. You come in denial mode. Increasing cost gap with revenue. This is problem with many of these semi-governmental organizations particularly, and they try to justify that whatever they are taking a revenue, there is no cost gap. But increasing cost gap is really pulling down those organizational performance, but they keep denying that there is no cost gap because of some overriding different considerations they want to follow. It could be social consideration, it could be political consideration. Incomplete and false disclosures. You have many examples in India also where still you deny we have done all disclosures and there are no disclosures, wrong disclosures, incomplete disclosures. Then last I would say the perpetrated frauds and non-compliances. Many top name organizations who were regarded as one of the top governance, best governance companies, but still there were frauds and they never denied till it came to a situation they could not resist except to disclose. Second virus is, friends, what I call arrogance. Arrogance means basically it comes in again in mind of leader and with the feeling that nobody can duplicate our products. Past success or past realities get wrapped under this present realities. You're not listening to young ideas. Organizations employ young chartered accountants, young MBAs, young management accountants. They come out with very, very bright and shiny ideas, but you decide not to listen them. You just hear them, but not active listening. Feeling is smarting than others. Friends, then one virus I call is a complacency, which you are well aware of. Most of these government-run organizations, whether airlines, whether banks, the post office, they were under regulated monopoly and it became complacent, and finally because it was dependent on subsidy and government support. So you get to become complacent, and you've seen this mainly in banking sector, aviation sector and courier services. Last virus I have added post 2008, greed obsession, and all this financial community and the associated agencies try to justify every investment in the name of, some kind of over leveraging, over trading for sake of money. And finally, everything falls through. Subprime, for example, scandal was outcome of that. I would have loved to detail it out, but in interest of time and subsequent slides are very, very important. Now, friends, when it comes to cost management strategies, I must, in one slide, I have tried to capture what are the strong enablers and pillars for that. You see that first, my cost management focus should be reduce the cost of capital. And capital is not only the capital provided by the shareholders, but capital provided by lenders or capital even generated by the business. How do you reduce effective cost of the capital? Number two is divest and hive off non-performing businesses and non-performing assets. My dear friends, in any business, I can safely tell you, you go through a company balance sheet in a practical mode, you will find almost 20-30% assets, including tangible assets and intangible assets, human resources or non-human resources. There are 30% which are, you can call, non-performing, non-engaged, not remunerative assets. And some of the assets are not even in existence. The best thing would be to now separate out, impute from the business so that you can have a real return on the available assets. That is what I mean is the second layer. Now business driver is now sitting on the two legs. One is operational excellence and other is my long-term value creation. We are always day-to-day obsessed more on operational excellence, which means confining to volume growth, working capital management, price optimization, cost reduction, and asset utilization. Now these are the pillars which we see as a part of our operational excellence in any business. I just try to highlight these 5 major things. On same end, long-term value creation like engaged employees, technology upgradation, innovativeness, and customer focus have continued to be there. We will deal as the time will permit, but without that, you cannot have a long-term value creation in the company. Like in pharma business, unless you think of next molecule, the long-term value will never get created. Something example of that type. So I have covered this volume growth, price optimization, cost reduction. Just trying to repeat something that, like, on cost advantages, you can think of manufacturing cost, purchase cost, supply chain, and related logistic cost. But other area is like underutilized asset. You may find, as I repeat, surplus assets, whether disposal of surplus empty properties, disposal of even intangible, non-core, declining brands, protect intangible assets which drive the value. This should be the core area of focus for to realize the proper utilization of our assets. Intelligent capital allocation, how much you can invest of that capex, where you should invest, again is a very important function from the cost point of view, whereby you derive very high ROC or ROI on that capital invested. And last is my chart is working capital management. I will just take a half a minute break. Sorry friends for the break. And continuation to that, coming to other cost which really is painful in my experience is a lot of cost, hidden cost goes through this working capital cycle and cash conversion cycle, which is in form of inventory, sometimes excessive inventory, bad inventory, multi-locational inventory, irrelevant inventory, timing which comes cycle time, receivables, your trade terms, and many other formats. and payables. This has two dimensions, time or money. So time is money, because if you get money to move faster around the cycle, collect monies due from the debtors more quickly, reduce the amount of money tied up by reducing inventory levels, increase the credit period from suppliers. You could have this management as like your own internal funding department, finance department, and you can reduce significantly cost of the capital within the company. You don't have to borrow even sometimes meant for your working capital requirements. I will not spend much time on that, but on same end, the focus of this slide frankly is that what are the cost optimization strategic map with financial perspective, customer perspective, investors perspective, and learning and growth perspective. The focus here is again coming to my improve cost structure, increase asset utilization, expand my revenue opportunities, and enhance customer value. I have just put this is BNPP other model. Now friends, if there is no measurement to any exercise, you cannot excel, and if you cannot excel, you cannot really achieve the purpose. So I have prepared a sort of tally of financial tools through which only you can measure the impact of cost management strategies. So what is that toolkit which any management accountant must be mindful of this, must be having this like as a carpenter carrying its toolbox? It is to any chartered accountant who is on core finance position or management accountant, he must possess this toolkit box. So one is financial tool, measurement tool kit, which is you are familiar with ROCE, return on capital employed, return on net worth, return on sales. Then EBITDA to net sales, that is to measure your business margins, free cash flow, your debt equity ratio, DSCR, debt service coverage ratio, EV economic value addition, MBA market value addition, then EPS, price earning ratio, total shareholders return, and market cap. Now this is like as a similar to comprehensive health checkup of the body when you go to any best pathology department, and you have to find out through various like ratios. These are the various measurement tools and techniques to know your financial health of the enterprise. Similarly, there are known financial toolbox also. You should not feel that this is not your domain. It is as good as like a chartered accountant must be familiar with that, which is like customer satisfaction index, market share, defect ratio, because this will determine your future financial performance of the company and enterprise. NPD, new product developments, manufacturing cycle times, new IPRs, leadership bandwidth, CSR, employee productivity index. Friends, I have just read out very fast, but these are the key tools which without that you cannot ascertain a true financial health of the company, not only the present status but going forward next 3 years or 5 years down the line. You are all familiar with, I take it, basic ratios through which you can again measure the corporate health. For operating performance, like I focus on EBITDA to net sales to measure the business margins, business performance. You have to compare this with your past period and you have to compare with your competitor. Then only you will know how better you are doing with respect to your previous period and vis-a-vis your other competitors. Then there is a significant cost where our focus has to be there. Material cost, fixed labor cost, I call that as a process cost. To determine efficiency, your fixed cost fixed to net sales and process cost which is fixed to net sales and process cost which is variable to net sales. Now this analysis, again you have to do a lot of deep dive into each of the significant costs relate with your net sales. That will reflect automatically a trend and signals where you need to impose certain controls and take immediate actions, because as Mr. Goyalji also has mentioned, this is cost which is under your control, and without waiting for year to end or month to end, this red flags, as and when comes, actions have to be immediate or imminent. Tax, I call also as a cost. There is a lot of ways and means, legitimate ways and means you can optimize this cost in terms of tax planning. Balance sheet ratios, basically I focus on current ratio, debt equity ratios. They are also directly, indirectly with your cost efficiency. That's why I'm bringing on the table. There are hybrid ratios. One is ROC, profitability measurement on capital employed. Sometimes what happens, you might be showing very higher EBITDA, but your ROC is declining. That is immediate signal that your assets are not getting properly used, and which means there are either idle assets or there are overcapacity you have deployed in the system. Inventory receivables turnaround, I mean that number of days of sales, and this is one significant cost, and I think in many organizations I have seen through this you can bring a lot of operational turnaround with a very tighter and very IT-enabled processes through you can achieve wonderful, efficient working capital management. Return on net worth. And one last mother of the ratio I want to harp on, EVA, and this is ratio which encompasses all the major ratios within it. There is two things which I always as a CFO would like to focus on you all and will submit that most important fact and health ratio is like cardiac ratio for the health is free cash flow. If you are able to see that free cash in the company in line with company growth in the revenue, profitability, then business is really generating free cash flow. If there is a corresponding free cash flow is not there, then there's something wrong. Either there are some falsification of the entries or there are some inefficiency which have crept in either on receivable management or asset management. Second derivative of that ratio is cash ROC to return on net worth. Question arises, why? What is then purpose of why do we need enterprise value? That the whole idea is that these ratios or that cost management should create, upsurge our enterprise value. But why? What is the need to know enterprise value? Is something like we need a lot of alternative corporate and business strategies which could be in form of new product launch, new capex, joint ventures, new markets. You need to know your own enterprise value. A lot of corporate restructuring like mergers, divestment, acquisitions, high-ops, recapitalization. For value-based management to know the business performance of the operation or you're evaluating your own shareholders' wealth, you need to know this enterprise value where cost management strategy plays a very, very significant role. These are the tools of valuing that enterprise value. I have not taken this subject beyond this point, but these are the methodology based on income based, which has capitalization of the past earnings and discounting cash flow. Second part is market related, underlining asset based, economic value added, market value added. These are the broader tools which are best of the financial analysis use or valuers use to ascertain the value of enterprise. But within that, I want to little cover for your benefit. What is this economic value? This is tool to evaluate and measure the efficiency with which company has used its resources. EVA represents between the return achieved on resources invested and cost of resources. Now, when you talk of resources invested, is like fundings given by the shareholders, owners, as well as fundings provided by the bankers, lenders, kind of things. Now you take entire sum of that, what is the return you have generated on the total capital and what is the average weighted average cost of that capital. If the difference is positive, then you have created a positive EVA. If you have created less than that, then you have created negative EVA, which means you have destroyed economic value of the enterprise. This is the formula, which is NOPAT minus COC. NOPAT is calculated as per the best of the world management accountants, profit after appreciation and tax, but before interest. You reduce the cost of capital employed. And cost of capital employed is nothing, but it is weighted average cost of capital into average capital employed. This is just example. You want to just have a quick look. For example, your average debt in the company, assuming $500 million, average equity is 300. So average capital employed is 800. Now cost of debt post-tax assuming is 8.5%. Cost of equity assuming 17%, because that is also some broader benchmark is available on cost of equity. Then WACC, that is weighted average cost of capital, is 11.7%. If company's PAT is 35, you add back interest 65, so the NOPAT is 100. And cost of capital, that is average capital 11.7% on 800 million, that is 94. So in this practical example, this company has created 6 million positive EVA, which means this company is generating positive, it's adding economic value addition on a positive note. Now friends, I want to now come to straight one is, because of this COVID, I have purposely taken this phase. Now, how do we enter and move into new cost management strategic orbits? What is the preparedness which we have to do? What are the opportunities which we have? And how do we monetize those opportunities? This will be, I'm sure, interest to every one of us. But like for any final exams, we have to prepare ourselves so that we are ready to implement those all cost management strategies. So what are the preparedness is, first of all, we need to define the size of problem. So is COVID, just because of COVID, not all businesses are worse hit. There are some businesses who have done wonderfully well, but there are businesses which have really gone for the toss. One is defining the size of problem and carry out stress test to financial health. I given you diagnostic and financial measurement tools and techniques to measure this stress test. Then first of all, we have to put financial house in order with focus on cost components, liquidity, health of order book, customer credit, and 3 components of working capital, thereby strengthening my balance sheet. Once you do as is basis, just like doctor wants to know what is existing health, so he wants to know first existing situation of all the live organs. Then take a deep dive. How do we improve that and reduce the cost? And growth management, revisiting product mix and pricing, divesting non-core businesses, and prudent hedges. Prudent hedges, I mean, is something like when you are exposed to forex risk, for example, or price variation in certain commodities which are uncertain. So which are the hedges you have taken to minimize the risk of those volatility? These are the new opportunities with breakthrough ideas to focus on customer profitability. We normally go more profitability on our company rather than customers' profitability. Protection from damaging financial products. A lot of financial products are there once, like particularly in the areas of financial hedges, forensic economics, outsourcing of knowledge capital. Invest in R&D, required capex, retaining key talents to ensure future growth avenues, including through inorganic M&A. I put broadly, these are the preparedness to move in that new orbits. So what we do, if we take a little focus on the COVID phase, first of all, ruthlessly, and I repeat word sometimes, ruthlessly is the answer to the situation, then you are determined and committed to do this. We have 4 core drivers of the business. If I can sum up in that way, one is revenue, then cost, liquidity, and profitability. So how do we flex with operational strategic lever to conserve, first of all, free cash flow, which is prime need for any company in this given time. A focus on free cash flow is there, sometimes at cost of marginal losing the growth also, doesn't matter. But if you are sitting on a free cash flow, friends, I can bet for you, you will be the real winner when the opportunities start knocking to you, and you will be able to grab those opportunities as compared to anyone else. Embark on business restructuring initiatives with focus on NP and low productive resources. I mentioned about business restructuring is not only M&A and kind of things. It is also doing away your NP and non-performing assets and low productive resources. This is the time you can think using this restructuring exercises. I have been repeatedly saying this working capital components, this really has a lot of impact on your cost management. And important other point which is within our control is like relentless control on cost and overheads. For example, reduce cost of capital. I'll just share with you few examples. How do you bring the cost of capital? In organization, there are say 4 products and one product is not profitable. So what you could do is you can reduce allocation of that capital to the product which is not generating enough returns and allocate more capital where you are earning more returns as compared to cost of capital. That's how you can maximize. You will find various places there is an idle capital through your treasury management. Then you need to see that how best you can reduce that idling capital element within the company. Third is that there are a lot of, again, in treasury management, tools and mechanics, how to determine the mix of the capital among working capital or debt or equity or quasi-equity, or in debt also there are various formats of the debts also, leveraging on even ECBs, FCCBs, for example, exports, you can leverage on that, PC and kind of thing. So ultimately, how do you reduce the cost of capital is by reducing the cost of capital per se and bringing down the cost of the capital which you invested. Other thing is cost of operations. Frankly, though it may look very simple, but cost of operations, I have just gone through a recent actual exercise. So let me share with you what that exercise has meant to you all. You come across a lot of discretionary cost, which can mean a lot of activities which are wasteful, not contributing to purpose of your company. By reducing those unwanted, unproductive activities, you can reduce those kind of cost. There is also admin cost also on the areas of travel, rental, subscription, club membership, electricity, pantry, car expenses, meeting in luxury hotels. If that is not a relevant cost, you can take a list from your accountant, what is the cost structure over the last 2 years, as detailed as possible, and then try to put, is that relevant for your earning the revenue today? If it is not relevant, then please immediately put a stop and do something whereby the cost is not incurred. Some of the cost, like particularly CapEx and some non-mandatory cost, which you can defer it for the timing, because timings are uncertain. Today, I repeat, your focus should be on conserve free cash flow. So if you can think to defer some of the cost without creating a clutter in your operations, please do that. Then some of the accountants come to me and say that, sir, there are certain contracted costs already, so how can we reduce that? I can tell you out of box, you can call all these your contracts, renegotiate, and nothing wrong with that, which can be your IT contracts, which can be your security contracts, which can be your AMCs, which can be your insurance. Sometimes you can go and renegotiate and bring down the cost through that process. One area, again, cost of operations is called outsourcing of non-core activities. Now, instead you're incurring, this is the opportunity for you to think what kind of outsourcing you can do. It could be payroll, accounts, data processing, IT applications. Some of the things which you can think to outsource, and many companies have done that to bring down the cost and bring down the cost of mistake which you are likely to make in handling those activities. One interesting thing which comes in some of the companies, I am aware about that, is called pooling and aggregation. You need certain spares, for example, and your competitor needs the same amount and same type of spares. Instead, you both getting spares separately for them and us. You can have a pooling of spares in such a manner. You don't have to keep double quantity. You can keep between two of you one spare instead two expensive spares, so you don't have to invest too much in that spares. Through that pooling arrangement and collaborative arrangement, you can bring down a lot of costs in the matter. One part you must be seeing and you will really feel excited, I call, is a variabilization of cost. We tend to incur huge cost, particularly like real estate, on fixed cost, very total high component of fixed salaries for the people. I want to see that if whatever maximum you can variabilize this cost, the cost you should be able to ascertain and back to your per unit what you produce. Then you will stop bleeding. Otherwise, what happens? Today, see that in Bombay, renters, they were paying, say, like 10 lakh rupees. But it was good when your revenue and profitability was X. If today revenue and profitability is reduced to 50%, your fixed costs, how do you absorb? So now issues are coming whether you can variabilize that cost also. So instead incurring on that real estate, you can go for lease of small place, amortize on that reduced volumes. So this is what I call variabilization of cost. There are a lot of opportunities which you can build immune system to make your business competitive post COVID-19. With that learning, this is the time you can do a lot of cleaning up your wasteful activities, including delayering, for example, the point which I am already giving a separate point. Organization structure sometimes is so much A reports to B, B to CD, CD to something, 3-4 layers. Now you can eliminate unwanted layers and make that layers as simple as that possible. You reduce manpower cost, you reduce also the complications of that different communication and bring down overall cost structure. Now friends, one of the things which I always like to cover is risk management. Now on risk management side, apart from the basic thing which you all are familiar about, yes, various risks, but as per one survey, let me tell you that overall risk business is exposed to in general strategic risks, which is due to demand shortfall or mergers and acquisitions failures, customer pricing pressures, loss of key customers. They account for something like 56%. Whereas supplier problems, cost overruns, accounting irregularities, supply chain related 31%, financial is 6%, hazards like natural disasters is 5%. But this is composition is a mix and of the basket of lot of industries. So industry wise it will widely vary. It may widely vary. But having said that, what are our risk management mitigation tools? One is elimination, where you could use your business consulting and restructuring, whereby you don't have to really take that risk if you don't have appetite to absorb that. Or alternatively, you can with technical improvement, risk engineering, you can reduce the risk, you can transfer the risk like in an insurance or contract terms like PVC price variation clause, and something we have to retain it. While it looks simple, but in real life situation, you have to really install a formal process within the company for each of the activities and then find out which are the key risks for each of the activity and impact of that. Should that risk happen, then what could be impact? Accordingly, you can devise your mitigation plans. If it is a top-down approach, I tell you this can be one of the best financial device and cost management technique which you can have. I call this is always a best practice. Apart from that, in any case, there are certain cost controllers and management accountants have preventive and detective and corrective techniques. Anyway, because of now ERP, mostly data on digital side, you have to have proper authorization metrics, so nobody can tinker with the master data. Nobody can, authorize changes in the production server and master data, of course. Business system integrity and continuity controls, physical safeguards and access restriction control, whether it's humans, financial, physical, information assets, and effective planning and budgeting process. So these are the part of preventive. But on detective and corrective side, your regular internal audit, it has to be very effective. External audits, your reconciliation inventory counts, your comparison of reported results with plans and budget. But these are some of the things. I have not given a complete checklist over here, but these are the broader control techniques. Now on cost management strategies, the best practices wise, I have a lot of things, but I've just picked up 7 or 8 best practices. One is, as my experience, and in fact I was talking to CFO of Microsoft world over. I had a chance to meet him up in one of the speaking sessions in India only. And when I asked him what are the 3 best things which he does for Microsoft, he reports to Bill Gates, now he's going to do that. So his first focus is reliable financial reporting system with focus on cost center. I've taken that learnings in my heart and started implementing. And I can see that it is really making a lots of difference if you have a reliable. So you have to reduce human interventions, because sometimes, it gets polluted once it is left to the humans to interpret. Then marketing fellow will report sales different data, accountant will report different data. So if it is ERP control, then let it be through that whole pipeline. The output should be through that ERP system only. So there should be a report of integrity, reliable report with focus on cost centers. You segment your business by product lines, by markets, and by customers. Your benchmark financial performance against standard which you have set or targets which you have set. Your focus on gross margin target for EBITDA earnings to build value. Then you have an accurate direct costing system, what you load for arriving at costing of the product. That is very important. Whether you are able to absorb the entire cost, otherwise something cost which remain to be unabsorbed, then how do you deal with that is also issue. Measure your cash cycle for working capital and manage it. You forecast your working capital, arrange your growth financing well ahead of the needs, then you are not looking cash starved, you are not feeling cash starved situation. And drive accountability and communication throughout the organization with scorecards and key indicators. And since I have, as a CFO, always believe in free cash flow, so I always very passionate for this. And to say that not in a fearful situation, if you run out of the cash, the game is over. For that reason, you must attend to cash flow at all the times. I almost every week get into my cash flow situation for the company. So review your cash flow at least once in a month in detail. Look at your receipts and disbursements on a daily job. There's nothing like big science into it. These are the basics of the business. They should not be just in the anxiety to have a complex management system. One should not lose sight on this daily cash flow and receipt and disbursements. Know how much cash you have in hand, how long it would last if the money suddenly stops coming in. This is like risk management things. Know how much working capital you will need for the next 3 or 5 years. Now friends, having said that, it would be rightful for me to take you through one corporate case study and how these have been practiced in real life situation. And I have no hesitation, rather take a pride in sharing with you. I have been one of the principal partner and party for implementation of this corporate case study. So this experience will be, I'm sure, going to be very helpful if you want to relate with your respective organization which you work for. So one first phase I call is a survival phase towards building new competitive advantage and achieving cost leadership. Because what has happened, sometimes in 99 and 2001, the disastrous years when struck by the turbulence like economic tsunami. And a 65-year-old corporate registers first time in the history a tremendous loss that point in time, 146 crore in 1 year, then 73 crore, whereby net worth of 65 years gets eroded by 50% in just two years' time, which created a ripple effect of low morale on employees, customers, purchasers, and their families, and gap in relationship with business partners, where the bankers, then they were not willing to give any clean credit or support or cooperate customers and suppliers due to lack of trust and confidence. So this was the outcome of this 2 bad years. Question is, what went wrong? You have to know first root cause, then only you can cure better. First is, of course, it was overall sluggish scenario for the company which was within power sector. High capabilities built by the industry led to pressure on unit per realization. So as I mentioned to you, on my capital side, you have a heavy idle capacity which got created. High material cost and excessive workforce scenario with plants located in Mumbai. How do you measure? Because I was watching through process cost, and in process cost, year after year, it was showing as a surging for that process cost. And revenue side was declining, but that is not in your control. That is what customer is willing to pay. That is what market forces determines that rate. Stiff resistance to adopt new age techniques of financial engineering, sourcing, building cost efficiencies. So there was some kind of resistance among the minds of the people to adopt these new techniques, and slipped into sort of complacency. I said about complacency part in my leadership virus theory, followed by imprudent working capital management. I have uttered this working capital 8 times by now, in high debt and interest burden, over-relied on channel partners and conventional method of treasury management and sourcing practices, which has made funds more expensive and commodities also bit costly. What is meaning of treasury management inefficiency means fund costing become higher, and sourcing practices means your cost of inputs also got very high. Exports taken as an area of opportunity instead major thrust. So to overcome that, today's talk is how one could survive. So in this company, there was then clarion's call of 3-pronged strategic approach. First was improving productivity, something quite a scientifically measured technique called most Maynard's operation sequence technique, which was introduced, whereby company's productivity level has gone up by 50% to 200% across all the 25 divisions. Number 2 is conversion to low cost, high yield environment. It was a tough choice, but VRS was implemented in Mumbai. Manpower reduced by 4,000, and lot of plants facilities got relocated from Mumbai to other areas. Basically, Mumbai being high cost and low productivity to low cost and high productivity areas. And third call was fiscal management, control on inventory receivable management, rationalization of borrowings, efficient cash management system, and rigid cost measures with focus on materials and process cost. So these are the 3 clarion calls. We were working on 3-line approach concurrently. It is not one after other, it is concurrent processes. Then sourcing and marketing initiatives were taken, whereby each product group to efficiently compete in a marketplace, and reduced where that there were non-productive multi-location scenario, because a lot of inventories was getting jammed because of multi-location. And company also created a core competency in that business, what it was, and business which was not part of core competency, either we have divested and provided cash as a result of the divestment to cash-starved operation. So there were a lot of operations businesses which, even though profitable but not aligned with the strategic intent of the company, or it was not falling within core competencies of the management of the company, we divested, exited out of that. The cash realized therefrom were at least provided to cash-starved operations. Then cost reduction through value engineering, other measures which were implemented. And this has transformed this company from a survival-focused outlook to a sustainable, growth-centric organizational mindset with change focus either through fundraising or improved risk management practices. I'm not going to deal, these are the things which you have already dealt in my earlier things, but what I'm trying to say is we have literally practiced those tools for this company in letter and spirit. That is the power of focus. And finally, as management accountant or chartered accountant, finally you see your mark sheet. And finally, this is the mark sheet, scorecard. Your inventory management in year 1990 to say 2004 and 5, this is the area where we focus on this survival phase. From 107 days of inventory, it comes down to 47 days. You can see constant improvement, and it doesn't come automatic. It comes through a sustained and deployment of that cost management strategies, working capital management strategies, then only it has come down. You see debtors level from 140 days to 92 days. Again, this is a improvement, remarkable improvement. Sorry, sir?
एंटीबायोटिक का असर है जितना सामान है बोलो तुम रेडी आई थी जितने बदरपुर बोल रहे इतने आए थे बदरपुर
एक रेड एक अट्टा और एक वो आना है बाकी 3 है
अरे अभी तो एक सीमेंट ही आना ना बाकी तो आ
बाकी सब कंप्लीट है
तो सामान आया था पूरा
सामान आया था
सुरेंद्रपाल जी
आवाज आ रही है सुनाई
हाँ जी सर
सुरेंद्रपाल जी आवाज आ रही बीच में बहुत
हाँ जी should I continue no sir
sir please
okay.
Sorry for
Then,
that
sir, no, not at all. On the sub creditors improvement also you can see the same scorecard performance 134 days to 106 days. And most important, as I told you, the world best leaders focus on 3 things. One is relentless attention to cost, and this I'm saying not my version. This is a average, weighted average of 5 best world leaders who run today billions of dollars companies, but common plank is relentless attention to cost, cycle time, efficient use of capital. And see the cycle time, which is 2.5 times in year 1990. Now we were able to, churn that same working capital 6.5 times in just 4 years' time. That is the secret of this performance. On your borrowings, for example, which was 851 crore, came down to 314 crore in just 5 years' time. And debt equity ratio, which was 2.33, that was 2.33 times, came down to less than 1. And so it became known as one of the best management companies on financial side. And sir, interest costs, if you look at interest cost to net sales, which was one point in time, 7.39, the time when we embarked on these initiatives, whatever I mentioned, that including cost management strategies, in 4-5, it came down to bearable 1.17%. And these graphs, visually you will find, whether it is EBITDA level, PAT level, EPS level, it shows very significant performance. Then immediately from survival and revival, you enter into a finally growth phase. And how do you do that? Through re-engineering, again, cost management strategies. So these are the various, again, the same drivers I have spoken, I have just implemented levers for purpose of this company, whether thrust on exports, whether operational efficiencies, to ensure higher capacity utilization, variabilization of cost, going ruthlessly on cost management, picking up the every cost, whether it is relevant cost or not, churning all these discretionary costs, pooling of the costs, outsourcing of the cost, where lower interest rate, and on top of that growth phase, we have done couple of acquisitions, also acquisition after year, and you may see now that kind of my final scorecard. If you measure final value to the shareholders is in terms of EPS or PAT, in year 2019, which was 146 or 47 crore negative, then next year 200 crore negative, slowly in just 8 years time, on a rising curve, finally in 2010, it attained a fact of 850 crore PAT. In terms of market capitalization, it reached in 9 years time from X to 150X in just 9 years time, which was a corporate milestone in the country, let me tell you. Now, if I want to place before you, end of my slide, is that what should be key takeaways within recent regulatory framework. We should not also leave aside, because of COVID, lot of relaxation which have been announced by the government of India, by RBI, and you all should also take support of these regulatory supports, relaxations, stimulus, which will reduce your financial stress, make your cost structure more competitive. You will be reasonably for short term insulated from disruption phase of the COVID-19. You should focus, I repeat again, and I will keep repeating as you interact with me, on free cash flow. Even though it may mean slightly lowering the cost on returns, your business model has to be kept high. It's again like fittest of the survival. So you should not, at leader level, you should not really start fumbling, because for any good days to come, you have to go through this one of the most turbulent time. And last but not the least, but most important vital things, which I believe is leadership virus. I repeat only for sake of your refreshing part, denial. One should not be going in a denial mode, arrogance, complacency, and greed obsession, because these are the offshoots of any leader's mind. And this we have to do our internal surgery and remove them to become as a best leader, to create value for the company and ensure right economic revival, sustainable economic revival, profitable economic revival, and growth-oriented economic revival. This visual might give you some message, is that new age management accountant, and if he's chased by COVID-19 and will continue to be chased by COVID-19 disruptors, regulatory bodies, continuous rising cost with no certainty and visibility of revenue going up, then still how do you survive? And you see the zebra riding on the motorbike, and the zebra is nothing but our economy or company which we all work for. As long as we are focused on my business levers, if you recall business levers, I have quoted through one slide where I put one lowering the cost of capital, high of your free non-performing assets, then operational levers and long-term levers. If you focus on that and free cash flow, as long as you have right technology to drive, this zebra is driving on a right motorbike. I don't want to say which company it is meant for. Going with the right speed, so not looking a complacent that मैंने achieve कर लिया तो सब कुछ हो गया, ऐसा कुछ नहीं है. It has to be constant speed with the right business model. So he must have outsourced some of the activities he doesn't want to take through himself, and he is in compliance to moving ahead through this bike in terms of his road permit and all kind of enablers. Then I tell you, he can leave behind disruptive aspects of the COVID, changing of the regulatory bodies, and rising cost alarms. So friends, I have tried to cover while in this given time, though this presentation was originally to run over 100 slides, but I will like to use available time to interact more. If this platform will permit, then I would love to share with you
We can,
that your
if you
insights.
want, we can continue for 5-7 minutes more.
Okay. Okay, sir. So what I will like to do one thing. Let me see that. Anyway, friends, then what I'll do is in fitting in the context of this today webinar on strategic cost management. One thing again I repeat is not that I am referring to cost cutting. I am not referring to again cost containment. I am referring to encourage all that relevant cost. In a way, other way around is you may want to increase your relevant cost on spending on right technology, on creating a better systems and processes, by hiring the right people so that they can become future leaders. Some on cost management should not be mistaken as a cost cutting. As long as that relevant cost is generating better returns for the company, better economic value for the company, then it is not at all the idea of reducing that cost. But having said that, in any organization, with my experience of large 7 corporates in the country, if you really take pains of going through that cost data, component wise and period wise for last 2 years at least, then you will find many of the costs is controllable. Either there is a discretionary in the nature, or that is just conventionality that has been going on and has no bearing on the revenue potential. So you have to go ruthlessly on that cost. So that is one area I wanted to repeat. Number 2, I want to repeat is very important aspect which many organizations have not been able to practice, but now they have realized the need for having this variabilization of the cost. So one has to be mindful before committing any cost. One should do stress tests. Should that revenue become 50%, would you be in position to afford level of that cost? If not, then one should go in for different model. It can be reality cost, it can be your other fixed cost. So make, buy and hiring decisions should be linked to that whole thing. Third, on my cost management side is very important is my finance cost, which people feel that there is a treasury department is sitting in some silo side, they are taking care of. My finance cost is not only interest cost or bank charges. It is use of the capital within the company. So it is like allocation of the capital with your business heads, with your product lines, and try to find out what is that each business unit, SBU, is generating returns on your capital which you have deployed. That is 100% management accountant's role and responsibility. If you come across a situation that returns given by SBU is lower than the cost of capital, then you have to raise that red flag to your senior management or with board members. Then view will be taken. Either they see some kind of future vision differently, then you have to get convinced, or at least now you are able to put a brake on that. So you can maximize return on that overall capital within the system. So it is like you're working as internal bank for your SBUs. That is the concept which I want to advocate. Similarly, on working capital, I have already repeated, but my experience was that earlier, you remember that CST was there and VAT was there, regional sales tax structure was there. To save, companies were creating multiple warehousing situation. So too much of the overloading, unloading, and warehousing, then distribution centers, which was making inventory cost and inventory carrying cost very high. Now with central GST being there, you can eliminate your multiple storage points and reduce the inventory. It is not very ideal situation like GIT, as Goyal Sahab has mentioned, they have practiced, but at least you have your major inventory suppliers close to your works. So thereby you can save a lot of inventory carrying cost. Inventory carrying cost again is not interest on that inventory. It is also bad inventory, obsolete inventory, and that inventory. Finally, you end up having that and you have to write it off. So you reduce that inventory cost. Same thing theory helps for receivables, and you have to see your customer terms. How strong are they? How are you securitized with that? Your sale and servicing of the business, if that is not advance payments. So you have proper LCs, whether you have proper backup guarantees and kind of things. Or if there is a risk of bad debts, then you have really bad sale. And that is a big cost in a way. Then you are losing the entire sale value, and that becomes a biggest cost. And one cost which again we really take as if tax manager will take care, that is direct cost, which is direct tax, which is income tax. Now, if you are sitting in a corporate office, then sometimes when you look at your multiple company structure, you find some companies are paying income tax, some companies are not paying income tax. Some companies have carry forward depreciation, some companies have carry forward losses, other companies don't have that and they are paying at a marginal rate of tax. Now here is your brain. You can think of some company structuring exercise, merge some of the companies, and thereby you can offset your existing losses to future potential profits and bring down your tax rates. Nothing wrong with that. I am advocating for legitimate tax planning, which you must be mindful and aware about that, and you can bring down the cost because you are paying 25%. It's not a small cost, so to say. Last but not the least, before I end on this again, is end of the day, whatever you save through your cost management, each penny saved sits into your final profit and earning per share and shareholders' wealth. There is no further linkage to that. Your earning on top line 1 rupee not necessarily will go in making the profit, but your saving of 1 rupee in the cost will straightway add to your profit and loss account and final profit to the shareholders. So that's why this webinar I call is absolutely in the finest context in today's time for revival, survival of the businesses, enterprises, and economy. Because all this put together, nothing but it is economy. So with that note, I think Nanda Sahab, Aroraji, I will right now like to put a break on my formal presentation, and I'm sure if there are some Q&A, I will like to take them on in interest of the time.
Sure, sir. Sure, sir. Thanks a lot. Thank you very much, Mr. B.R. Jaju. It was a wonderful presentation. It was a wonderful deliberation. You have made the dry subject interesting, basically, with the slides and with the practical experiences on hand and with the case study. It was wonderful. There are certain questions from the participants. I would like to you to take up one by one. I'll read out the questions, please.
Sure, sir.
Friend from Cuttack, Mr. Ankit, wants to ask, as we are aware that commodity prices are on the surge, because of which either we compromise on profitability, quality, or the demand of the product. What steps have corporates taken for this?
Okay. So, if I understood the question correctly, is that if commodity price is rising, so he is seeing as a threat to his future profitability. Yeah. If that is his fear, then I would say, I don't know which business he is in, but most of the commodities, particularly metal, iron, oil, one can always have two kind of arrangement. One is long-term contract of the supplies, where he knows that irrespective of market fluctuations, the price is packed at the time of contract itself. That is one way of doing. Number two is that is called price variation clause also. And in that way, your end product prices also to the customer can be linked to the price of that most volatile raw material. For example, if let us talk of copper. Now one is supplying product made out of the copper, and if that is eye to eye sale, industry to industry sale, then the contract can provide a price variation clause. If that copper price goes up like that, then my sale price also will move accordingly. This is true in case of like most of the transporters arrangement with respect to diesel price. If diesel price goes up, accordingly the transporter also stand to gain, or if there is a reduction, he has to pass it on. So this pass-through arrangement is one of the technique which can help doing this. Number two, having said that, world is too big, and my experience, sir, I am sharing with you, is there are also through reverse auction techniques, sourcing through low cost countries like China, Russia, where most of the products would be available at 30% lower or 20% lower than normal sourcing techniques. Purchase managers, with all due respect, in many companies have a stiff resistance to change their mindset. They are always in that denial mode that my suppliers are giving me at the best price, which is not always so. If trying out some explore market outside low cost countries or reverse auctions, you will sometimes see a big difference on the cost and quality of the commodities. So these are some experience base I have shared with you. Let's find out with gentleman whether does this answer to his question or he is looking for something else.
It's a question from, of course, a member of the CF fraternity asking for his clients basically, or for his basic knowledge himself. The next question from a participant of Bangalore. Most urgent issue is creation of demand. This will help revival rather than cost control when we go to the quantities.
Yes. I have worked under one of the top industry captain of the country, and same question was posed to me when I was young boy at 37 years, but still as a CFO of that company. That there is no demand, sir, for my version, but he said that you can go and create demand. Now, how do you go and create demand? It was in context of PVC price, that plastic things. Then he says that the demand is restricted to demand what is the statistics are available. But he says, why can't that product be substituted for other complementary product? If that, for example, that jute ka thela, if that can be substituted with PVC, what are all required in terms of regulatory framework and government approvals? If that happens, you create additional demand because you are hitting on the extra application of the product. Then you can automatically create a demand. You go through your neighboring countries, if they are in dire need of your product, why don't you think to export that whole product to that neighboring countries is another creation of demand. Third factor is you make your product attractive with extra delight features. In a way, then you will create demand in place of your other competing product. In case of cars, this is what is true. If you bring some extra features in IT products, what is there? Extra features that create demand at the cost of some other competing products. So demand creation is also study as a human psyche study, customer psyche study, what they are looking at. So it is a totally outside in approach, not inside out. But we normally in India operate inside out more in the illusion world that we are doing the best. But if we take a feedback of customers, what they are looking at, and we fit into our product, demand will get automatically created.
The next question is from Mr. Shaju. The next question is from Mr. Nitin from Mumbai. He says, what about non-availability of required labor due to COVID-19 and its effects on the production of goods? How to manage the same, because this will ultimately affect the cost of the product?
Mr. Nitin, that this is problem across felt by many industries. Textile was the initially worst hit. Some of my friends who are in textile business, they realize the same amount of business they are able to do now, 50% of the staff which they were engaging pre-COVID period. So it is like, earlier there was excessive deployment of the people. And another thing is also they also focused on some of the processes they started making more semi-automated. Third is a lot of activities which was just doing for sake of doing. They were wasteful activities, eliminated that also. And fourth is now in this digital world, the place does not matter. So the people who were doing physically coming to the office, now they can do at a distant location where they have left and give that job. They can do accounts work, sitting outside place, tax work, they can do outside work. Lot of digital activities, the place does not matter. So those people can be engaged while they are not available in Mumbai. But some of the physical activities, if they were doing, the analysis says that barring few genuine cases, that with improved productivity, they are able to churn out much better than what they were doing before. But yes, certain issues were there, but now a lot of industries have addressed already this issue. So I'm surprised how he's feeling this being as a still serious issue. In month of March and April, yes, this was very much alarming issue that point in time.
Sir, the next question is from Mr. Suresh from Qatar. When we talk of cost control, generally we hit the headcount cost first. What are your views on the same?
It is a wrong notion. I have first said that cutting down productive headcount is again, intensifying the problem further of your business viability and business sustainability and business existence. As long as you are cutting down headcounts which were not at all engaged for the company, which were not productive resources, which are not otherwise also contributing to the company's purpose of growth, profitability and all that, to that extent fine. But if you are hitting that headcounts, which are today and tomorrow useful and critical resources, on the contrary, you have to retain them at any cost. You don't have to really cut their salaries. You can always work out some kind of mix of fixed and variable component in such a way that it still remains for them bit motivated, encouraging to stay on with your company. So idea is not to cut that cost. So if somebody is hitting on that, I think is in a wrong mode.
Sir, now the next question is from Jyot Sifat from Jalandhar. Can free flow of cash the cost management strategy as solution for new viruses after COVID era? Leadership virus and arrogance viruses you talked about.
Yes. Both are two different things. Free cash flow, yours should be aim, yours should be target, yours should be working strategy. So if you have free cash flow, then you are in a better position to make use upcoming opportunities and you will be much more competitive and advantageous as compared to others because you have that strength. Leadership virus are to do with something your mindset. If because of that extra free cash flow you become complacent or you become arrogant and you stop listening to say good ideas from your younger people, you stop listening to the customer voice, you stop listening to your employee's voice, then it is a first symptom of your arrogance. Or you continue to remain in the business and you know that business has become obsolete and you still feel in a denial mode, then you are really destroying the value for the company. How that IBM 3 times have also lost business value because they were also in denial mode. Computer Corporation of the company in US, despite the best top company one point in time, but they really blinked on that PC revolution and they felt that PC is not something they will like to do, and they lost the value because of denial mode. You have another many examples. In fact, that best of the Fortune 1 company, that GM Motors, also came under denial mode that Japanese cars cannot destroy their market, and they denied that part, and eventually what happened? They lost the market leadership. At one point in time, it came very close to heavy loss company. So my point is, sir, this virus things which I advocate to keep away is purely a leadership different training course. They should not get affected because of these 4 viruses: denial, arrogance, complacency, and greed obsession. This is universally true. Otherwise, irrespective of whatever you do, the business is set to fail and underperform. So both are two different things.
Okay, sir. Sir, the next question is from Mr. Prashant from Mumbai. As we say, cost is in our hand, but not the sales price. But if one starts reducing cost, will it not likely to affect the quality of the product adversely? How does one balance between cost and the sale price?
Or combination of both. When I say sales is not in our hands, is generally in products like where customer is the king and he has multiple choices, and market forces decide the price of the product, then you don't have much say on the price for the product. So what you can do is 2 things. You add some to that, and the premium feature will create a differentiation of your product with rest of the. Now you may have incurred say 100 rupees in that premium feature, and you can charge for 100 rupees extra 200 and increase your profitability. So what I'm trying to say in this, your sales strategy can be such whereby you also generate a goodwill for the product, then you have every right to command extra premium for that product. So you have to work both ways. While sale price is not under your control, but you make your product which is like create attractiveness in the industry buyers, then you will charge more, and cost there too is much less. Coming to the cost management, I have given a lot of cost control techniques and a use of that without compromising to quality. Eventually, your long-term stay is that your best governance practices not to compromise on quality what customer is looking at. One has to do that. एक छोटा सा एग्जाम्पल मैं देता हूँ आपको कि फॉर एग्जाम्पल वी वर एक्सप्लोरिंग फॉर एग्जाम्पल ये लो मोटर्स जो होती है. Now, if you do everything with the use of copper, then your product is uncommon because you are able to sell that. So what is copper, as long as that motor can still function for the intended purpose, you can bring down the cost. So that is like value engineering you can always think of doing, but without causing a dent on quality of the product.
Sir, the last 2 questions, very brief questions. Mr. Amit from Jammu, how you foresee economic revival in coming times?
I wish I was to be finance minister of the country. Today we live in the era where difficult to predict, but intelligent guess is the kind of right now surroundings and murmuring which is there. India is definitely set to have an explosive growth because of various reasons, consumption-led economy, and right now the challenge which was there pre-COVID, that challenge cannot now overall disrupt that overall economy strength. So compared to many other countries in the world, we are well positioned because of our very population itself has become our asset. So consumption-led, our demographics have become major strength. So the consumption pattern will make all the difference. And thirdly, our export potential to serve a lot of other countries. India is in the best position as a low-cost country, as a better quality country, and better serving country. With that, I think we have a going forward strong economy emerging.
Sir, the last question from Chennai from Mr. Vijay Raghavan. How can sectors like hospitality, tourism, etc., which have been affected by the pandemic, be revived and made economically viable?
Whatever has happened, that cannot be undone. Unfortunate part, these are the worst hit segments of the economy due to pandemics. But as we have learned a lot of things in our journey to insulate from pandemics, now with that insulations, vaccinations process, a lot of other precautionary process, and hopefully pray that this virus will lose its strength, then this will reduce to one of the basic disease, then this industry will survive. But the industry which is sitting on a free cash flow, industry which has shown its capability to absorb this loss, and still they have not lost the moral, they have not lost the key people, key resources. I think they will definitely start doing well, if not now, maybe a couple of months from now. And but I cannot predict what would be real dimension of this virus. Nobody can predict, but I can see now world has become much wiser than it was before in terms of controlling. Earlier, nobody knew that what would happen. So suddenly, whole world has gone under lockdown, which will not be the case, hopefully.
Sir, it was a wonderful deliberation, wonderful question answer session, and the knowledge you have disseminated is par excellence. You have talked about denial, arrogance, complacency, greed, revenue enhancement, then capital cost reduction, operating excellence, long-term value creation, divest NPAs, profitability and cost ratios. I don't see the topic which has been left out. Things which are in your control, things which are beyond your control, tax is also a cost, how to reduce that. It was certainly a wonderful, wonderful deliberation and wonderful guidance for every participant. Sir, it is certainly a game changer. Your wisdom from wealth of knowledge have certainly made each one richer and wiser. Your Compton Greaves case study, which is your first-hand experience, has certainly made everyone wiser, and this is a guiding story for each one who has participated. Thank you very much, sir, for so much of guidance, so much of knowledge spread, so much of dissemination of knowledge. It was wonderful hearing you, listening you. It was wonderful having a session with you, sir. I thank you a lot
for your kind words.
For the program. I thank you a lot from the core of my heart, from my institute, from the Committee of Management Accounting. And I thank the team of the committee, CA Gyan, Dr. Surinder Pal, Mr. Amit, and of course in absentia, CA D.D. Goyal, who deliberated the keynote address and wonderful words were said. I thank CA Charanjot Singh Nanda for organizing such a wonderful program. Thank you very much. Thanks a lot, everyone.
Thank you, sir.
Thank you, sir. Thank you very much, Raju sir. Thank you.